Hello millionaires and future millionaires. In today's video, we will talk about 3 simple rules to invest for beginners. Warren Buffett. So, let's start. Warren Buffett says, I read all the books on investing in the public library and I ate it up. It was fascinating to me, but I had no framework. I was just searching for something. I was hoping that little things on a chart would tell me something about what a stock was going to do. It was kind of crazy. But everybody else was doing it, so I figured I'd do it too. Sometimes you turn the chart upside down, it still wouldn't help. Then in 1949, I read The Intelligent Investor by Ben Graham. I'd never heard of them up until then. And there are really only 2 chapters in that book that are the key to it, but they set my philosophical framework for investing in 3 ways. They're so basic and so simple it's hard to understand how they could be that important. But the 10 commandments are simple. The first is that a stock is part of a business. You can't think of a stock as something different. It's you value a business and then you divide by the shares outstanding. But what you have to think about is what kind of a business are you getting into? What are its economic characteristics for its competitors? What's its management like? All of these things that relate to a business instead of a little ticker symbol. I used to know when I was 11 or 12 the ticker symbols of every company virtually on the New York Stock Exchange. I could mark the boards of Harris up them, but I didn't know anything. I knew that X was U, S steel and T was it T and so on. But I didn't know anything. I didn't know what was behind them, so I had to start looking at these little symbols or these little names in the paper as businesses and decide, how do you value a business? What counts? The second thing in the book is that Graham gives you a marvelous set point in terms of how the investor should react to stock market fluctuations. He talks about his mythical Mr. Market in chapter 8. There's been no better thing written in terms of the investor's attitude toward stock prices. Most people react the wrong way to stock prices. They feel good when their stocks go up, they feel bad when they go down. They think the stock market is there to instruct them, and Mr. Market is this partner you have in investing. He's a remarkably obliging partner. This guy comes around every day, and he tells you what he'll pay you for your interest in the business, or what he'll sell you more at the same price. Nobody ever does that in private business. If you and I owned a gas station together, and I said every day, I want you to come in and offer me your half interest in the station, and I can either buy your half or sell you my half at the same price, and you have to come in every day and do it. You'd be at a terrible disadvantage. And you'd be at a particular disadvantage if you're Mr. Market in the market, because Mr. Market, or a friend of the market who obligingly gives you those figures every day, different figures at the end of the day, in the start of the day, but he's naming a price at which you'll either buy herself. The beautiful thing about him is that this guy is an alcoholic, manic, depressive. He is as unsound as they come. He wanders around all day, and looks at the crazy things. And he's going to name all kinds of crazy prices, and you don't have to pay any attention to them, except when it's to your advantage to do so. If that's once a year, if it's once every 5 years, it's 1 stock out of 3,000. All you have to do is sit there. You have no moral responsibility to this jerk. He is naming these numbers. You didn't ask him to, but he's doing it, and all you have to do is pick the one time when he is particularly depressed or particularly manic or particularly drunk or whatever it may be, and the market will be all of those things. And you take advantage of it, and that's what's remarkable about stocks, if you think about it, is that if you look at the high and low on all of these American companies for the last year, you'll see case after case after case where the high is twice below. Now that's for sound American businesses running along, paying people, selling goods and so on. If you go out, look at farmland 10 miles from here, there's no way in the world over here that the farmland is going to range in value from X to 2X. It doesn't maybe go from X to 110 of X or vice versa. If you look at an apartment house near here and figures on essentially apartment houses like that over a year, it won't move 10 in a given year. But here are the finest of American businesses, and people just name these numbers that go all over the place. And you don't have to play except when you want to. That's the important thing, and that's what Graham tells you. The market isn't there to instruct you to tell you anything. The markets is there just basically to serve you when you want it to serve you. One of the most important things remember in stocks, very hard to do, but people have all these feelings about it. The stock doesn't know you own it. You're sitting there with these certificates for Berkshire. The company doesn't even know you own it, and the stock doesn't. It's trading now and they don't know you own it, so it has no feelings about you. You've got all these feelings about it, but it's just part of a business. If Berkshire is worth 75,000 times 1.5 million shares, roughly 110 billion or something like that, it's a good investment. If it isn't, it's a lousy investment. You have to value the business. And Graham, it's amazing, but people don't do that in Wall Street. You hear price targets or that kind of thing, but you see no one write a paper that says here is the nature of this business over the next 20 years. What should that business sell for? Forget about what it's selling for. In fact, one of the things, third thing in Graham's book is the margin of safety. If you come up to a bridge and it says capacity 10,000 pounds and you're driving a 9,800 pound truck, you drive down further and find another bridge. Nobody knows exactly what that capacity is, and it may have been signed, may have been put up 3 years ago, so you always leave a margin of safety. You don't try to cut things that close. You wait till something kind of shouts at you in the stock market. And with those 3 principles you can build all kinds of structures on that, but that's the foundation. And if you've got that in mind, and that's in the intelligent investor, I've never found anything that remotely compares with all 3 of the ones. You can't get rid of one leg of the 3-legged stool and still have a good investment philosophy. But I would say that the most important thing over a long period and working with big money is to understand the business. Let's just say for the moment that you were given $1 million or whatever sum was necessary, and you could look around Knoxville or look around all of Tennessee if you want and buy into any 3 businesses. Between now and a week from now, private businesses, not trading or anything of the sort. You've got a week to do it, or you have to give the money back. What will you be doing during the next week? You can look at all these companies. Some of them you're quite familiar with, some of them you're less familiar with, some by reputation, some of them the management, some of them the rest of your life. You're gonna be looking for businesses that have enduring competitive advantage. You don't want to buy a Burger King franchise just because nobody's come within 10 miles of it yet, because Wendy's and Donald's and all of those will be there pretty soon. Just get rid of all kinds of things. For more videos like this, hit the subscribe button, and remember to click on the notification bell so you get notified when we post a new video. Thanks for watching.